Welcome, everyone. Today we're going to talk all about loan modifications.
Yes, loan modifications. What are they, why, and how? So what is it, Louis?
So modification, that's when an individual that owns a property has a loan and they want to modify it because they're in distress, right? They're in foreclosure.
Yes, so sometimes the payments, the terms, the interest rate,
Yes.
the term of the loan, how many years.
Yes, but remember this, guys. They might have bought this asset, this property at a low interest rate, and now the existing interest rate that is in the market right now is higher. So it might not always work out right. It might be where their property, the interest rate is higher, well, the payment is going to be higher, right?
Yeah, so it won't make sense.
Yes.
Correct? So why would a borrower want to do that in the first place?
The majority of the borrowers want to get out of foreclosure.
Yes.
So that's number one, right? They want to try to avoid foreclosure.
Yes.
And that's one way of trying to avoid
Yes,
foreclosure.
and they want to try to make those payments more affordable, so they
Right.
think, right?
Yes.
But that's not always the case. So there is a qualification criteria.
Yes, there is.
To get approved for this loan modification.
Right.
So a borrower must must prove they have financial hardship, and they got to show the ability to make those mortgage payments.
That's for sure. And then there is a debt ratio, right, Galen?
Correct. So with the ability of making those mortgage payments, their income must meet that debt ratio of 40%. So the payment must be 40% of their gross income.
Nice. I love it. Love it. Great explanation. So, and then the process, Galen. What is the process?
So there's a process. So to everything, there is a process. So,
Yes, there is.
Yes. So they got to contact their lender, number one. They've got to submit their application. So,
Let me stop you there real quick. You have to submit the application, but sometimes it's better to get a third party to help you submit that application because it's not a simple application, right? There's a lot of things going on with that.
Yes, a lot of moving parts to it. And so submitting the application correctly could, basically deny your application or approve it. So
Right. So it's a big
crucial.
Yes. And then what they do is they give you a 90-day trial period, right?
Yes. So if the application's approved, then you do have a trial period to meet. And
Yes.
so if you default during that 90-day period, it could revert back to the timeline that the foreclosure process is in.
But remember, let's go back to what we talked about before. It's the modification. It might not be a lower payment. It might be a higher payment. But some of these individuals, they take on the higher payment just to get out of foreclosure, and it puts them in a little more distress, right? So
after that 90-day period, the whole goal is to receive that permanent modification. However, there are some pros and cons that you were just discussing.
Yep.
The pros, of course, that it is always the intent to lower that monthly payment. If hopefully that interest rate or the length of the term is able to lower that monthly payment, that borrower is doing great, right?
Yes.
It helps them avoid the foreclosure and it helps them to remain in the property. However,
What are the cons? There is some cons, right? Lowering your monthly payment is not always the case. Remember, like we keep talking about, the payment might be higher, right? Having situation where you might default because your payment is higher.
Right.
Right?
Right. So in the case of if that happens, though, if a borrower does default, what happens, Louis? Does their foreclosure start all over, or?
It all depends, right? Like, look, if they default on the loan, sometimes they miss that first payment where they had that modification, the lender is going to start the foreclosure exactly where they stopped, right?
Okay.
So that
That's
is
really important for them to understand.
very important, right? So look, it's sometimes when they do the modification, it works out, and sometimes it doesn't work out, right?
Yes. The other con is that if they've been denied for a loan mod in the past, the chances, the highly likelihood that they are going to get denied again is pretty high, right?
Yep. And that all depends on the lenders, right? That really depends on them to who's more flexible and who's not.
At the end of the day, guys, I mean, many of these borrowers are trying to buy some time, or we're really trying to identify if this option really is for them. They've got to prove that they have the ability to be able to make these payments. Otherwise, it truly can be a waste of time for them, and they cannot afford that.
Good stuff, gang. I think this was a good session.
Yes.
All right, guys.
See you on the next.